Hello and welcome back to session 3 in this 6-part video series from GoNoGo Charts. My name is Tyler Wood. I'm a CMT charter holder. And today, as always, I am joined by the illustrious Alex Cole. How are you, my friend?
Fabulous.
We love talking to all of our friends over at Metastock. And today we're going to be talking about concepts in momentum analysis. If you've been following along the first couple sessions, we really stuck to just identifying trends in securities and a robust checklist approach to managing all of the data that's available to us. We want to be repeatable and systematic in our process to help avoid some of those emotional pitfalls that come to all of us as investors, the fear and greed of markets. But after we have identified the trend of the security, there are multiple other technical tools that can really help us in our trade decision making. One category of those tools fall under the momentum headline. Alex, talk to us a little bit about how we define momentum oscillators and these tools.
Yeah, momentum analysis is really the next place you're going to go as a technician once you've had that understanding of trend. And it's because this kind of analysis gives you really valuable information about price movements. We like to think of momentum as understanding the velocity of price change. How quickly is price moving in a certain direction? And then that allows us to look for extreme swings. We can look for areas of overbought and oversold. And we can also use oscillators in trend, which is a very, very important topic that we'll talk about later on. And of course, we're going to hit on the concept of divergence or confirmation. We want to look at these momentum tools and see if they confirm what we're seeing in price. And there's so many of them, Tyler. We'll walk through a couple of the most popular today, but you can see hopefully again that when you add these to your chart, the problem is your chart gets complicated. But let's dive in and take a look at some of these momentum indicators.
Absolutely. And just at a high level, when we're looking at trend, it's a lagging indicator. We're looking in arrears at where price is coming from. When we're looking at momentum, it's a forward-looking or leading indicator of what's happening that might signal exhaustion or acceleration of those very price trends. So apologies in advance if we didn't pick your favorite momentum indicator in today's class. But let's go through a few of these, starting with the most basic, mathematically, the most basic idea of capturing momentum. And that is simply the rate of change. So we're simply just looking at how fast is price moving. Now, in today's lesson, we're going to talk about both bounded and unbounded indicators. For those of you who remember the meme stock craze, indicators like the rate of change, which are unbounded, gave us some very caricature-esque data points as those prices moved in extreme fashion in both directions. So an unbounded momentum oscillator is going to range infinitely high or infinitely low, depending on the movement of that price action. And rate of change is simply a powerful tool to understanding whether that trend is accelerating or decelerating, or maybe coming to a moment of exhaustion. Now, one thing that Alex mentioned before is that we can look at areas of confirmation or divergence. Is the enthusiasm of market participants likely to help this trend continue, or is the enthusiasm waning? So if we look at the far right side of this chart, we're seeing price make ultimate additional highs, higher highs. And when we look at our rate of change oscillator in the lower panel, we're seeing that it's still positive, but it's making lower highs, telling us that the enthusiasm and the participation of the market in this trend at ever higher prices is coming to an end. That's a bearish divergence. So we're in an upward trend and our momentum oscillator is showing us lower positive readings. Alex, we like to use the metaphor of getting onto a freeway or acceleration, right? And so as you're entering the on-ramp, that car is moving faster at an ever increasingly faster pace. Once you meet with traffic, you might still be increasing the tempo at which you're driving, the speed at which you're driving, but at a lower rate of acceleration, right? You might move from 10 to 20 to 30, or in your rally car, maybe from 0 to 40, and then 45, 50, 52, 53, and then catching up with traffic at 55. Absolutely. So that's what we're talking about when we talk about the exhaustion of a trend and a decelerating activity. It's still moving higher, but at a lower pace. Alex, why don't you talk to us a little bit about the commodity channel index?
And what's interesting about all of these indicators is that they attack the concept in a slightly different way. So the calculation, they're trying to give us the sense of what's happening in terms of market enthusiasm and in terms of speed of price movement, but in a slightly different way. And commodity channel index just looks at how far away price is from a historical average. So you can get the sort of the sense of whether or not we're overextended, we're far away from a mean. And so that's what the commodity channel index does. It takes a look at price and looks relative to its historical average, how far away are we? And again, this oscillates therefore above and below zero. It is like ROC. It is unbounded in that it could be very far away from zero, or it could be very close to zero. There is no sort of set range for the CCI. And again, you have the overbought and oversold ideas, but with CCI, that's going to be arbitrary, as it is with any unbounded indicator. So imagine that for a different security, those levels might be different. You're looking at an indicator, an oscillator that moves relative to its own price action. So there's no sense of uniformity or they're not normalized in any way. So you can't use the same levels on an indicator like this. So you're going to look at the chart, you're going to sort of try to eyeball where those overbought and oversold levels are. But of course, that can still be valuable. And then again, the concept of divergence, as with all of these momentum tools, very important. And you can see at the back end of that chart, we've got divergence there again with the CCI, the same area that Tyler was talking about, the higher highs in price and the slightly lower highs there on the CCI. So CCI attacking the concept of momentum in a slightly different way, looking at how far away price is from a historical average.
And those divergences work in both directions, where here we see a price low that then made a lower low. Here we can see the oversold condition, which made a higher level of an oversold here with the CCI. That's a bullish divergence that preceded a rally in price. Not always an absolute buy or sell signal. Divergences in momentum indicators can just be helpful at giving us a place to pay attention to, sharpen our pencils, if you will. Alex, why don't you do another one on stochastics?
Yep, stochastics, again, a fantastic indicator. This one created by George Lane. And it was so popular at the time because it was created at a time and it just worked incredibly well for giving very, very good signals at the time. Now, remember, these indicators, a lot of the momentum indicators developed in a period of sort of sideways market movement. So finding the peaks and the troughs is a perfect example of how to use these momentum tools. Again, trying to attack the concept of divergence, but in a slightly different way. What we do with stochastics is we look at the current price and we ask ourselves, how high is it relative to a look back period? If it's the highest price of that period, of course, we're going to have the maximum value of stochastics. If it's towards the high of the range, we're going to have a high value of stochastics. Stochastics now is the first of the bounded indicators that we're going to talk about. Stochastics moves from 0 to 100. We tend to use overbought and oversold levels of around 80 and 20. That makes it a little bit easier to compare across securities, unlike the ones we talked about up until this point. And we've got two lines now in the stochastics, Tyler. We've got the percent K and the percent D. There's been work done to create more lines with stochastics. We don't need to go into that. You can continue to smooth these lines and get more, but percent K and percent D are the original two lines of stochastics. And that allows us to look for crossovers, just like we would with moving averages, as we talked about in the trend identification video. We can look at the faster stochastics, the percent K, and how it crosses above and below the percent D, which is a smooth line based on the percent K. So giving us signals now based on crossovers. You can think of looking at crossovers in overbought territory. What does that mean? Crossovers in oversold territory. How does that interact with your buying and selling? And interestingly here, Tyler, this is one where we haven't really seen too much divergence there. You can see that on the period you were talking about with the lower lows, those are fairly close in terms of level, in terms of oversold on the stochastic. And then again, with the higher highs in price, holding on to the similar overbought level. So a little variation there, interesting information coming from stochastics.
And you know, those overbought and oversold levels, I think the subjectivity that a lot of traders struggle with is whether or not 21 counts as an oversold Does it have to break 20? What about 80? How about 79? Is there a major difference in what we're seeing on the chart around those key levels that we could define as overbought and oversold? So a little bit of interpretation needed. Again, same set of data here on all of these charts, but the oscillators operate in slightly different ways. Let's talk about perhaps the most famous, Wells Wilder's RSI. So George Lane brought out stochastics in the 1950s. Wells Wilder introduced RSI, the relative strength index, not to be confused with relative strength, but RSI as a momentum tool in the 1970s. And that's a time when the US equity markets were in a range-bound and bearish market. And for a lot of investors, this became a central part of their toolkit, and using these momentum oscillators to identify points of mean reversion. So looking for oversold as an opportunity for trend reversion, right? Back towards an upward trend. If we're in an oversold condition, looking for a washout of or an exhaustion of the downward trend. And then looking at overbought levels for an area of exhaustion or a top in price action and a reversion to the mean. It is because of the context, the nature of markets at the time that these tools were introduced, that a lot of investors missed the opportunity on how to use these tools while the security is in a trend. And we certainly want to educate everybody who's using Metastock that a security reaching an overbought level, that is not a direct sell signal. In fact, for many securities that are trending higher, you can see repeatedly overbought readings on your momentum oscillators. So please be interested enough to go back and read the great works of the folks who invented these tools and understand what their intention was in developing some of the math behind these. But RSI is going to work the same way as these other momentum tools. It's going to be calculated differently, but we can look for areas of overbought, oversold, and for divergences as well. Now, Alex, let's do one more. And here it's just an adaptation of Wells Wilder's RSI. We look at the money flow index. A lot of traders call this volume weighted RSI. So we're bringing in another piece of data to that momentum reading, looking at the enthusiasm or the participation of market participants to that momentum reading. So we're going to look at price and volume to identify those overbought and oversold conditions with a money flow index. And it's going to generate those convergence and divergence signals when we're comparing the trajectories of price and this indicator, helping us to identify those areas of exhaustion or acceleration in trends. So Alex, we've got a lot of different momentum tools that we could look at, all of them calculated differently, all of them very powerful in their own ways. But when we get to a chart like this, right, we can use our GoNoGo trend, simplify what we're looking at from trend identification tools, and we could stack layer after layer after layer after layer of momentum oscillators that are giving us perhaps different views of some of the same data, looking at a similar concept. The problem is now we're consolidating our price panel and we're looking at data that could often be redundant or even contradictory. Here we see ROC, the rate of change, really topping over, showing us a divergence that we're not seeing in some of the others. So it adds subjectivity then when these multiple indicators don't necessarily always agree with each other. So what I'd like to do now is have you just talk to us a little bit about the GoNoGo oscillator and the concept behind blending multiple tools into a single panel below price.
So we have gone through this in the first couple of videos with the trend identification, the idea of taking the most commonly used, robust, sort of tried, tested concepts and indicators behind the foundational areas of technical analysis and blending them together into something that can give us what we need without overcomplicating the chart. So we take that same approach to momentum. We want the information from some of these unbelievable indicators that have been created. We want to understand the velocity of price swings, but we want one indicator on the bottom of our price chart that will allow us to get the value out of these tools, but without obscuring the chart and leave the price panel really large. So we've done the same thing. All of the indicators and more that you've seen before are blended together, that same checklist, but now for momentum, blended into the GoNoGo oscillator. So you can still see these areas of overbought and oversold. When the oscillator goes to an extreme, you see that line up with the peaks and troughs in price. So we're getting that sense of velocity, the extreme movement in price, and we can see that on the momentum oscillator. You can also, of course, look for divergence. When you see a higher high in price and a lower high in the oscillator, we're seeing bearish divergence. When you're seeing lower lows in price but higher lows in the oscillator, you're seeing bullish divergence. So we get the complete momentum picture, but just from the one panel in the bottom of the chart. And one thing to point out is that we've incorporated volume into this oscillator. When you see the ribbon on Metastock, that blue ribbon, that tells us that momentum is volume, is heavier than its average. So we get that sense of volume confirming. We get the value and the information we need from all of the multiple momentum indicators just in the one panel below price.
Absolutely. The whole idea is to simplify our view on the chart, to avoid analysis paralysis, but not to lose any of these important pieces of information that we are getting from some of the best technicians on the planet, the innovators in our space, who've created all of this powerful toolkit for us to use. In the next video, we're going to talk about the importance of using momentum oscillators within a trending security, and we're going to talk about the interplay between the price panel and this GoNoGo oscillator. So stay tuned for video number 4. Thanks so much for tuning in. We'll see you next time.